Hey guys, Boris Osberg from BK. Great to be with you for another week of trading. Last week, I had focused everybody's attention on my OO setup and had basically told all of you that I was going to trade the OO setup on a short-term basis to show you the results of how the week had turned out. There's a couple of things that happened this week that took me off course. First of all, this is a spring break vacation week in the United States. My kids are home, so I have really been only on trade for the first 3 days of the week. But secondly, much more importantly, after I had cut that video last week to you, I went back to the charts and did a lot of backtesting analysis and realized that one of the very, very big problems with trading the OO setup, running the OO numbers for continuation, the Momo setup, is that on a very short-term basis, you are subject to enormous amount of slippage. As you can see, for example, in this chart over here, in the pound that I just picked up at random, basically the run through the 49 extends it up, then extends it down, takes you in, takes you out. It tends to kind of stop you out more than it does give you continuation on the run. And that is one of the dangers of sort of trying to trade very short-term basis, because quite a lot of times you don't necessarily reach your targets on the first run or the second run. Sometimes you reach them on the third run when you get the nice big breakouts as over here. So I went back to my, I put on my thinking cap and I went back to the idea of, how do I want to optimally trade the momentum trade of running the OO numbers? And I realized that we already had a very, very robust model that we've been trading in the BK service for a long time. And I thought that perhaps what I should really do is start applying the BK money management model to my OO setup and see if I could extend and expand my my trades, both in terms of length and amplitude, and see if that would have any kind of a positive impact on my trading. So what I did is the following. Basically, as all of you guys know, we trade the BK model with a 2-lot position. The first unit gets taken out at plus 30. The stop on the whole position is minus 60. And just to give you an idea of why the stop is minus 60, it's basically all essentially approximations. The average true range in most of the major currencies is about 100 points a day. If you are minus 60 on your position from wherever you entered, you are 90 to 95% wrong on your position. It's basically a statistical stop that we use. We don't use any kind of a chart stop. We don't use any type of a pattern stop. We really simply use a statistical stop. If we're minus 60, we found that almost 90% of our trades that were minus 60 against us were wrong. So yes, there are occasional times when the thing will turn around and occasional times when you're going to make money with a bigger stop. But generally, the whole idea is to give yourself enough room to not get stopped out necessarily, but not too much so that you're losing too much on any position. So that's why we use a minus 60 on our day-to-day positions. And I thought, okay, maybe this is an interesting variant that I could use on my short-term trading positions on a day-to-day basis, on essentially my OO scalping positions. So here's a way that I created a BK way to scalp, which is that we take the move. Once the move goes through the OO numbers to the upside, we obviously take it to the long side. With a plus 30 stop on the first target, we trail the second target, and a minus 60 on the full position, which we move to break even, exactly like we do BK, and show you some of the results of how I basically worked that strategy. One of the key reasons why I really like that idea was the following. As you can see, a lot of times when currencies go through the round number, there's a very big probative period. They basically probe the number and see, is this a real breakout or a fake out? Is this a real breakout or a fake out? And you really can't tell until really sometimes time builds out that the breakout really is a substantial breakout. In order to do that, you need time on your side. And in order to have time, you need to have a stop on your side. You can't have a short stop, because any kind of a minus 20, minus 30, minus 40, even minus 50 stop in this position would have taken you out. So a minus 60 stop in this position actually would have kept you in a trade and given you the meaningful breakout and the advantage of that breakout a couple of hours later. The thing that's sort of maddening about the markets, if you don't really appreciate it, is that the first breakout can always be the false breakout, but it can be a signal to further strength down the road. And if you don't give yourself enough room, then you'll never be able to catch that further strength down the road, because you're going to get stopped out. You're probably not going to re-enter, or if you re-enter, you get stopped out again. And then the losses on the stops actually build up to really not make it very meaningful on the profits that you're going to get, even if you get the third trade correctly. And that was sort of the broad overlying philosophy with which I went into the week. And I want to show you what happened as I traded these positions on a basically front of the week basis. So let me just start here first with the euro, right? And again, this is front of the week, so my apologies that I don't have any trades for Thursday, Friday, but I've been basically off. So next week, I'll have a full week's worth of trades on this strategy. But here's Friday. This is euro dollar taking out the 35.50 handle. My first target is 35.30. It makes it in about an hour. And then I go to break even. And essentially, this is actually even a trail stop. It's not even a break even stop. It's kind of a trail stop. And I get taken out. And, of course, the euro dollar collapses afterwards. So the robustness of the BK money management, which is lock in profits when you can, and then hope for the best with the rest of the position, really, really worked very well in this particular case. Let me show you the much more active trade that happened in the pound. So the pound here, this is the 51 handle, for example. I was actually trading it a little bit on a 50 handle. I made some money on the 50s, and then I started trading the 51 breakout. So here we take the 51 breakout. This is an interesting adjustment that I kind of made. Remember, my first target was plus 30, and what happened was on my 51 breakout was it went up to plus 28, and then collapsed against me. Did not take me out on the first target. So after that point, I said, you know what? You need to make this a little bit more robust. So on the trades, I will now set my targets to plus 25 on the first target, keeping my stop at minus 60, and then trail up by quarters instead of thirds. But in the meantime, I was stuck in a position. And notice this is a 30-minute chart, how long this position lasted. I'm long 51. I'm holding the position through the New York session, through the Asian session. Boom, 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 boom. We have just a final vertical dip in the London session, which just comes very close to taking me out, but does not because it doesn't break the 40 handle. And then as London session comes up, boom, we have the real true breakout. I take the 25, then the thing runs all the way to 80. I move my stop to 50, and on the trail back, I make another 50. So net 75 points on the pound trade just off of this move, which was quite nice. Lastly, let me show you the yen move. So this was yen a couple of days ago when we took out 93 handle. And again, notice you take out 93 handle, and the whole thing is this is 30-minute charts. I'm waiting a long, long time for this trade to develop. I have the momentum on my side, but the general rule here is a lot of times prices will retrace and retrench and consolidate before they retest these levels and come back out. So come out of Asia, they break out 93 with a vengeance. It goes up all the way. I take out my T1 at 93.25, and then it goes all the way up to 93.50, and of course I trail myself back up to 25, another 50 points on the yen trade for the rest of the week. By the way, this is live trades, so this is live market action. So just showing you, look how nice. We took out 94. I didn't trade this today because I'm basically off. But we took out the 94 off the strong NFPs, and we took it out actually prior to the NFPs. If you were even mildly bullish and you position yourself at a plus 94, you could have seen that you would have survived. You would have survived this move to the downside because you would have had a 95.40 stop, and boom, boom, boom. Look at this power move to the upside once the 94 gets taken out. So bottom line is, it was like plus 30, plus 75, plus 50. That's about 155 points first 3 days of the week. Not bad for government work, as they say, and certainly improves your, I think, overall profitability posture, and hopefully improves your, your trading strategy as you go forward. Because by giving yourself wider stops, more positional type of trades, you give yourself time to let the trades work out, and hopefully. Of course, there's never any guarantee, but hopefully the strategy makes sense. I'm wishing you the best of luck. This is Boris Schlossberg for BK. Next week, more trades and a full week of the new methodology of scalping. We'll see how well it works out. I'll have more trades for you. Over and out.